Alright, gang, it's your boy Nature, aka Nature. Y'all already know what time it is. Alright, so let's get back into the videos. This video, we're going to be talking about entry triggers. So, this is extremely important. Entry triggers. So, entry triggers tell you when to fire, okay? When you get into trades and when to get out of trades. All entry triggers from buys to stops, to buy orders, to sell orders, to stop losses, to take take profits. All these are all entry triggers. Entry triggers tell you when to get in, when to fire, when to get out. Okay, it's very, very important. In our next couple of videos, we're gonna really dive in on entry trigger, and more as this more. We still have a lot to learn as far as the forex lingo, and certain words that you must become very familiar with. Just the definition, so you understand the definition, so you won't be so the more confidence you have in this trading game, the more you'll be able to make better trades. It's all about your psychology and how confident you are. So your entry triggers tell you that once you're in the potential trade area and when to actually enter the trade. It tells you once you're in a potential trade area when to actually enter the trade. So this is your specific entry technique. So now that you decide on where you're looking to enter a trade, now you have to decide how to actually enter the trade. Do you blindly just enter the trade? Do you walk across the street without simply looking both ways? Do you just walk across the street, start walking across the street? Only if you want to possibly get ran over. Of course, you look both ways first to make sure it's safe. So same thing in the same approach and practical with trading. You want to make sure it is safe to enter the market. Okay, so high probability trade setups. So you want to look both ways before you enter the trade. You want to make sure it's safe before you enter the market. Okay, and you'll have a high probability during the day, just breaking down the entry techniques, which can help you out when it comes to trading. So the entry techniques will help you and keep you out of trades that's behaving the way you would expect in your potential trade area. Okay, so let's pretend your potential trade area is where a bearish divergence is present. Bearish is usually stand for support or resistance. Say it's a bearish divergence present. Do you just automatically short, or do you just wait just because in the potential trade in the area of sells? Because bearish stands for sells, bullish stands for buys. So it's in the potential area. It just hit the resistance. And it just hit a resistance level, and it looks like it's about to drop back down for sales for the next couple of days, maybe a week or two. Do you actually just get in automatically on a short, or do you wait for price to hit near a significant resistance level first? Like I said, price will go to a resistance level before deciding if it wants to break that resistance level or it wants to come back down for sales. So no, you want to actually wait for price to actually hit a resistance level first. Maybe you want to wait for some type of reversal candlestick, like a shooting star, to form. Shooting star means that price is going down. Once you see a shooting star form on the market, it means that price is going back down. Okay. Instead of waiting though, you short. Instead of waiting and just being waiting for a shooting star price to hit a reverse on a resistance level, a major resistance level, some type of confirmation that price actually wants to go in that direction. Instead of waiting, you just get in and and then you watch price just climb higher and higher and higher and higher, and eventually stops you out, eventually takes all your money out the market and blows your whole account. Because you just wanted to get in the market without without the candlesticks, without doing your research, without looking at the news, without looking at trading view. You just wanted to get in the market. So when the market goes against you because you wasn't really studying, or you really didn't have an entry plan or a plan or a strategy to get in, then this what happens. Price will climb higher and higher and higher and higher and eventually stop you out. Just because you find a good area to trade doesn't mean you should just jump right in. Doesn't mean you just should jump right in. You should wait. You should actually see more confirmation from candlesticks, from it doesn't make lower lows, doesn't make lower highs and lower lows, doesn't make once you see lower lows and lower highs, you see a shooting star, an inverted hammer, you know that the market is possibly going back down. You see in it a bearish that the market is possibly going back down in that direction instead of just jumping right in. A good entry technique provides that solid confirmation is to help you when it comes to losing trades. So it's very important that you have a good technique that provides solid confirmation to help you keep you out of losing trades. So again, make a screenshot on your chart, label, write it down, do whatever you have to do where you want to push your entries at, where you want to trigger your entries at. So you want to map everything out. We're going to start mapping that out on TradingView. I got y'all soon. Don't forget that you must combine a good entry trigger with a good potential trade area. So you need to find a good entry trigger, some type of confirmation, some type of higher high or higher low, or some type of lower low or lower high, higher high, higher low, uptrend, lower low, lower high, downtrend, some type of confirmation combined with potential trade area, meaning potential price won't just go up and down. It'll go back to the potential trade areas before going back up and down. So you combine those two things together and then you get into a trade. Okay, so along with the moving average crossover, we are very popular, and average, once the candlesticks cross over the moving average, is on an uptrend, is going up. Once the candlesticks cross over on a moving average on a downtrend, is going down. So, and moving average 8 and 14, and once it crosses over the 8, crosses over the 14, or 14 crosses over the 8, so you have all these confirmation from your moving average, from candlesticks, from entry potential trade areas, that allows you to know when to get into this market. So the moving average crossover may be a popular entry technique, but if you don't factor in the areas and you don't factor in everything which you're thinking about, which you're thinking of entering, when you're thinking about entering, you'll be using entry triggers as standalone technique is a recipe for disaster. Okay, just saying, okay, I'm just going to get in right here because I think price is going to just get in right here, and you just get in and you enter a trigger for an entry, for a buy or sell right then and there, without actually studying the market or finding if it's either just going up or down, then that's going to lead to disaster. So we want to make sure that you're aware of your surroundings as well, so you don't bring a knife to a gunfight. So this is very, very important to understand. Position sizing. We talked about position sizing also. You guys like to position, like, what sizes are you using when you get into your trade? Are you trading 5 and 10 cents so you can last through the trades, 15 cents so you can last through the trades? Or are you trading dollars, 80 cents, 70 cents, and just blowing your account? So so how big of your size position is very, very important. This is an easy one. You must decide based on your risk management and your forex trading plan on what position size will be. So it allows you to know your maximum risk, how much you are willing to risk per trade. So are you willing to risk 1%, 2%, 5%, 10%, 20%, or are you going to bet the whole farm? Okay, so this is what happens when you bet the whole farm. So yeah, that's right. Do it. Let's bet the whole farm, right? So no, silly, don't bet the farm. So dude, where did your farm at? You just betted your whole farm. You betted everything that you had, and you lost it all because you haven't been paying attention. You haven't been studying. You don't want to become a gambler. Okay, we're not trying to gamble. We're trying to trade. We're trying to profit. We're trying to feed our families. So unless you're really a farmer, you probably don't even have a farm anyway. So Positioning your sizings is so important because it helps you in your account and it helps you stay alive in the account. And it's very healthy, and it's actually the best way to approach the situation is to not risk all your account. To only risk 1% of your account, 2% of your account, maybe 5%, 10%, but not 80%, not 90% of your account, 100% of your account. How many times you would think that's going to happen? It could go against you one way, one wrong time, even though it's the same trade as resting your 90, the same trade as 90, and if it was 90 or 10%, it's the same trade. But what if it goes against you? Then you want to have as many opportunities as you can and maximize as many times as you can off of the market. So it's important that your positioning sizing with sizes you're using and when you're trading is very, very important. It's important notes to take down, how big or small you are trading. So you want to trade small, especially for newbies, and just be like even like experts and they don't trade. Sometimes they lose. Sometimes they go through a losing drought. So it's better to risk only small percentages of your account by lowering your positioning sizing so you can last through more trades and profit more in the long run. By keeping track of your positioning sizing in your journal, you can see whether you're comfortable trading large positioning sizing. So every time you're trading, you should be writing this down in your journal. You should be taking this serious because this is your life. This is how you're going to feed your family. This is how you're going to help people around you. So you should be taking this serious. So your positioning sizing should be written down in your journal so you can see whether you're comfortable with trading large position sizes or you prefer smaller lot sizes while you're using wider stops. Luckily for you, we have a gift. And it's a tool session. We have position size calculator to help you math and find the right numbers of units you should be trading. And we're going to go over that soon. Okay, so let's just go over the psychology as far as trade management is concerned. So trade management, you need to take all this into consideration. You need to have a game plan before you just enter the trade. Before you just even consider the trade, you need to have a game plan. That game plan tells you how to manage this trade, whether it goes for you or against you. Entering a trade is the easy part. It's exiting the trade. It's where you determine where you make or lose money. So two types of traders. There's Tom and Jerry. So they take the same trade, right? But the two have total different outcomes. Tom's outcome will be he'll make money on a trade because he's probably managing his trades and plans to exit for a different scenario. Even if he loses, he will know when to stop bleeding and get out with a smaller loss. Even with a smaller loss. Jerry, on the other hand, does not have a plan in place. He does not know what he's going to do. If price goes drastically against him, eventually wiping him out. And price goes drastically against him and eventually wiping his whole account out because he didn't have a proper plan, trading plan, an exit plan. You have to have an entry plan and you have to have an exit plan to when to get out the trade, or not you're going to end up like Jerry and dramatically the price goes against you and eventually wipes out your whole account, and then you're wondering like, oh, am I the worst trader in the world? No, it's just that your position sizing was too high and you didn't have a plan. You didn't have a plan when you're going to get out. Pips are you going to get out? When it hits this a certain amount of pips, I'm going to get out. You didn't have no type of plan. So it's critical to determine how you want to manage your trade before you enter the trade. Okay, do you want to be making you don't want to be making critical decisions in the heat of the trade. Or you don't want to be making critical decisions while you're already in the trade. You want to already have this already planned it out, already mapped out when you want to get out the trade. You should have all this already written down before you even get in a trade. That way you have some type of plan and when you enter this trade, you should already decide how the outcome is going to come out. You should already have a plan on how the outcome in every possible way is going to come out. So when you enter a trade, you should have already decided how you will react to every possible outcome. Okay, so these are all the different possible outcomes that you should be looking at. So every possible outcome, try to figure out all the possible variations that come and occur and decide beforehand what you will do. beforehand. So 5 o'clock p.m. when the market closes, you need to come up and try to figure out all the possible variations that could occur before you enter that trade. Okay, so be like Spock. You want to be cold-hearted, emotionless. Okay, like a robot when it comes to this trade. Okay, you should be like a robot when it comes to trade. You should be like constantly on it. So all decisions are made before a trade. Okay, that's how you should trade. You shouldn't make your decision. You shouldn't trade and then make a decision and with your head cut off. No, you should have already made your decisions, already have that planned out, mapped out before you get in the trade. Okay, this means you are not yet in the trade. When you're a proactive, it means this is not yet. You're not yet in the trade. Active means you're in a trade. So deciding to enter a trade, you simply refer to to eliminate any past decision makings or any like big decision making. It's important that you already made the decisions before you enter that trade. So if you do not trade, if you do not take that trade, you already know where your initial stop loss will be placed, where your profit target will be placed, and your trail stop loss will be placed, and where you might get out of the trade early. Okay, so it's very, very that we have a strategy and a plan when it comes to trading. Okay, if you were giving a pop quiz, and at any given time you're during a trade, if you was giving a test, you would have to study for it. Same thing with trading. You will have to study for it. So you should be able to answer all the questions. You should be able to know everything. You should be able to know what what the minute chart's doing, what 4 hour chart's doing, the daily chart's doing. Okay, before you even get in the trade, you should study before you take the test. So you must have your trade management rules fully planned out ahead of time before you trade initially. You should already have this planned out. You should never ever be thinking like, what the hell do I do now in a trade? The time that you decide such things always should be before you enter the trade. You should already be having that planned out, mapped out, and you'll be way, way more successful. I actually do this a lot. And it's not just trading, with everything, and it helps a lot. You should already, when you do anything, you should have it planned before you make that move, before you make that action, before you make that trade. So this is just to help with your psychology. This goes like with entry triggers. The video I just made on my OnlyFans, this also goes with this video. So being retrospective means to take a look back at the events that already have taken place. So when you tempting to go back and hit your homie back up on a happy hour to kick back because you made money, but it's critical that you review how your trades went. Even if you win or lose, you should be reviewing your trade. It's very critical. You should be taking it very serious. Okay, this is a $66 trillion market. People make millions in this market. So take it serious. You want to look back over your process, your whole process, and understand what you did and what you went wrong at, what you did right. Here are some quick questions to ask yourself. Okay, how well did I trade with? How well did your trade work out? Was your positioning size right? Did your positioning size was right? Did your risk reward ratio was right? Did you trade too large? Did you trade too small? Could you have entered a better level? Could you what tools might you have used? Did you use the trending line? Did you use Fibonacci? What tools could you have might use to help improve your entry timing? Were you patient enough? Did you rush everything? Rush and thinking and never never had a chance again? Was your take profit realistic, or was it a pop high? Did the market pay respect to your choice of profit level, such as stopping short of it, or did the price blow right through it? Did the market pay respect to your choice of stop loss level, such as stopping short of it, or did the price blow right through it? What was the news like? How was the news affecting the market, and in which way that it moved for you or against you? Use these answers to refine your positioning sizing, your entry levels, and your order of placements, and go for you have to be serious about this. Okay, why are you playing with this? Okay, you could make millions in this. So how well did you manage your trade after it was open? Were you able to effectively monitor your market while your trade was active? If so, why not? Why weren't you? Have to answer these questions. It reveals a lot about how much time and dedication and how devoted you are to trading. Did you modify your trade plan along the way? Did you adjust your stop loss, or protect your profits, your profit at all? Goes out on a trade based on your trading plan, or did the market surprise you in somehow? So base all your answers and learn what roles your emotions may have played and how disciplined you are as a trader. And while you may want to vent your thoughts and your emotions and your feelings to your homies, they're not there when it comes time for you to trade. It's only you. It's only you there when it comes times to trade. So it's better for you to go through this yourself. It's better for you to write this down and just go through the emotions and feelings by yourself. Okay, I know you're probably like probably bored to death, and you're thinking you're bored to death by what I'm saying, but this improves your chances of trading when you take it serious, when you have a plan, when you have a strategy, when you write it said to consideration. You actually find out your take profit. Do you take partial profit? What can you improve? What specific steps will you take for improvement? This is your opportunity for the trade. So you must, every trade you want to improve. You want to have self-improvement through every trade. So do not take this down. Do not take what I'm saying lightly. Okay, I need you to win. Okay, so I need you to win, and you have to know when the wins are long, or when you need to cut your losses, or you need to be more disciplined. And when it comes to your trading, when it comes to writing down your notes, when it comes to this trading, these are usually what people don't take serious, and this can help. This is why they get that far when it comes to trading, because you have to be dedicated. You have to be it's better that you just trade in a demo account first for 6 months to a year before you even decide to actually put your real money into this. The market's not going nowhere. You need to understand the basic thing before you actually get in a trade. These or this is useless. Identify specific steps that you will take to improve. How long will you hold your winnings for? How will you hold winners longer? Will you work on choosing a better take profit? Will you learn how to not freak out at the first sign of a loss and when prices falling against you? So there is no wrong or right answer in this review process, because just to be honest, which just is all about you. So just to be honest with yourself, as you can, and be specific. Write everything down. Otherwise, you won't improve as a forex trader. Okay, you won't improve as a trader. So, did you execute your trades accordingly to your plan? Did everything go accordingly to your plans? You want to take these questions serious. You do not want to take these questions lightly. If you want to be a profitable trader, it's about routine, and if you're not routinely executing your trades according to your plan, then you either have a problem with self-discipline, or there is a problem with your trading plan that needs to be fixed. So these are just like this goes on with entry triggers. This will also improve your entry triggers. It's just looking at what price is going to do, your win percentages, your loss percentages. Just looking at everything. So I hope this helped, gang. In the next video, we're going to talk more and more about it. And about entry triggers and just like everything. So, gang nature, gang.